Perfect. Sorry about that. Good evening, everybody. Let me admit this person. Just to pick up from where we left off from our last class, and it's just a few slides, we were talking about debt and different ways to pay debt and some strategies that are pretty popular and pretty common that we wanted to share with you. So, like two of the most debt reduction strategies, like the common ones, are called the snowball repayment plan, where you will prioritize paying the debts with the lowest balance. And then there's the avalanche, and it's also called like a power pay, where you prioritize the debts with the lowest interest rates. And well, first, let me start off with if you've ever heard about either of these, throw a one in the chat. Has anybody used them, have any experience with them?
I have used these both very successfully with different folks. Yeah.
Yeah, and we have just like a little bit of a video to kind of explain it more in detail. And I apologize for the
Protect your
ads.
dreams under our roof.
Isn't this the dream, Grandpa?
American Family Insurance.
Planet Fitness. We're all strong on this planet.
One more, everybody. So first of all, what is the difference between the debt avalanche and the debt snowball debt repayment methods? Well, the debt avalanche method is basically when you focus on your debt that has the highest interest rate and you focus on paying off that debt first. While on the other hand, the snowball method is where you focus on the debt that has the smallest balance and you focus on paying off that debt first. And then you take that extra money from paying off that first debt and you roll it into your next smallest balance and thereby building
Oh,
a snowball effect with your debt repayment. With both of these approaches, you essentially need to create a priority list of your debt. So with the debt avalanche method, you're going to list out all of your debts and organize them by highest interest rate to lowest interest rate. And with the snowball method, you're going to again list out all of your debts and organize them by balance from smallest balance to highest balance. And that's the priority as to which you're going to pay off your debts. And the way you actually pay off your debt using either of these methods is that you focus on paying as much money as you can afford, more than the minimum payment, to your priority number one debt while paying the minimum payments to all your other debts. And by paying more than the minimum to your priority one debt, you're able to get ahead of the compounding interest and pay this debt off quickly. And then once that debt is paid, you take all that money that you're putting towards that priority one debt and you put it to your next top priority debt. With the avalanche method, as you go through the different priorities of your debt, you will find that the debt that you're paying has lower and lower interest rates based on how you prioritize your debt. And with the snowball method, you'll find that as you go along with your debt repayment process, the debt that you're paying becomes larger and larger. However, this is based
sorry, I don't know
on the
what he
priority that you
said.
have set to focus on paying off your debt that has the smallest balance first. So which of these methods make sense for you? Avalanche versus snowball? Well, the answer is that it really depends. If your focus is to really save as much money as possible on interest payments as you work towards debt freedom, then the debt avalanche method might be the one for you, because when you focus on paying off the debt that has the highest interest rate, you're essentially minimizing the impact of compounding on your debt as you work on paying down that debt, because you're tackling that highest interest rate first, right? However, if you're someone who thrives on quick wins and you want to see quick progress being made as you pay off balances, then focusing on the debt that has the smallest balance, that is the snowball method, can be more beneficial or more your style. Whichever one of these methods you use, they both work and they are both effective with paying off your debt. The key is prioritizing your debt, paying more than the minimum payment on your top priority debt, and staying consistent with your plan, and you will definitely see the results. So, are you in the process of paying off debt, and which of these methods have you found is working for you? Have you even
Okay, so are there any questions about either of these payment methods? And I know that in the chat, it looked like Krista, you had a kind of a comment or a question where you said seems like you'd pay the highest interest rate first, and you said you were confused. Did that get answered? Or do you want to elaborate a little bit more on what you were confused on?
Sorry, I'm just muting. I think she did say that. I think she said pay off the highest interest rate s- debt first. So so that,
Yeah, that's for the avalanche method.
and
And
for
so
the snowball, it's the smallest amount. It would
amount,
be like done,
yes.
done, done. Yeah.
Yes. And
Okay.
then with that, after you, so say you have five debts, right? And you are doing snowball or either payment method, right? What you'd also want to think about when you're doing that is like setting the amount that you want to pay for your debt. Say you owe 1,000, you want to pay, I don't know, $100 a month between your debts. Say you're doing snowball, you pay that debt off. Now, what you would have paid after that debt was paid off, apply it to the next payment that you're trying to pay off. So now you get to add, you continue to add more on what you're paying on. Does that make sense? Perfect. Are there any questions about either of those methods?
They're very cool methods. The one thing to look out for is what I put in the chat, which is don't accumulate new debt. And it's really hard when
Yes.
you have this clean credit card that has nothing on it. It's tempting to go ahead and put something on it. Just don't, because that's how it works.
Yes. And just another note on like prioritization, what that kind of has to do with collections. In the case of collections, it's better to pay off newer debt first because the older debt has less impact on your credit. And then after 7 years, it falls off, right? Just kind of think about where you are in your goals, what makes sense, and knowing that if it's a 5-year-old debt, it's not affecting your credit as much. Let that fall off while you prioritize what you have in good standing or what you can get back to good standing if that is the case. And if you're paying off collections, it's best to pay it in a lump sum because setting up payment plans can restart that 7-year clock. And when you can and where you can, paying it off in a lump sum. And I'm not sure, and maybe you can elaborate on that when paying off collections. There used to be a time where you could be like, yeah, I'll pay to delete. And I've not had any real experience with that in the last few years, but is that still something you're hearing, Suzanne, or has that kind of changed?
So I didn't actually hear the one little word in there. So you would,
When paying off a debt, like,
uh-huh.
hey, can we do a pay to delete? I owe 700. I
Oh,
want to pay
pay to
this
delete.
lump sum.
Yes.
Yeah, because then I've also heard now it's not like they can't change your credit, but I've actually had that done before, well, maybe about 15 years ago. So,
Yeah. It's something I always recommend that people ask for. You're not going to get it very often, but it's really nice if they take it off the credit report. The piece about paying off your older debt last, what's important about that is that debt is yours. It doesn't go away. But after 7 years, it drops off your credit report. So it's no longer hurting your credit. This is the important piece. That debt will often be sold to other
hmm
agencies, companies, and then they'll come back to you. And if you actually acknowledge that that's your debt, then it starts all over again. So don't, if a debt collector calls you after the 7 years, just hang up.
yes,
Not all debt falls off your credit report, right?
that is true.
Yeah. Unfortunately, student loans do not fall off your credit report. Child support, alimony do not fall off your credit report. Yeah.
Tax debt,
Tax debt is the only other one that doesn't fall off, and you are correct.
yeah.
They're trying to get so that medical debt doesn't come off, but right now medical debt does come
Oh,
off after 7 years. That would just be a complete nightmare if they did that.
yeah. And I would say I also am a mediator for the county with small claims. That is one of the worst kind of cases that I see where, oh, I thought I had this with my insurance or getting that like, oh, when your insurance says this, and then after the procedure or after whatever you've had done, your insurance comes back and is like, oh, we're only paying this amount. And then you see so many people coming to small claims court for medical debt, and it's really just kind of like a heartbreaking thing. But I do want to follow up on one thing we talked about with collections where it was that pay to delete. Does everybody know what that is? If you do, just go ahead and throw a one in the chat, give a thumbs up, or if you have a question about it, please feel free to speak up or put it in the chat.
Tried either one of them.
Oh, she's
Sorry, wait, what?
back.
Did I
So
miss
first of
something?
all, what
No,
is the
she's talking again.
Oh, yeah, it's like I have to click
difference?
it twice.
Here we go.
Perfect. So, student debt, and when it comes to student loans, does anybody in the class have student loans? Go ahead and throw one in the chat or a thumbs up. Oh,
Matthew and
I'm
Krista do.
sorry. Let's go back, Michelle. I'm sorry. You said you don't know what a pay to delete is. So, what it looks like is say you have something in collections, you call that company and you're like, hey, I want to settle this, but I want to pay you and I want you to delete it from my credit report. And
Okay.
back in the day, this kind of used to be something they would do. You would want to get that in writing because sometimes they'll say that and do something else.
Mm,
But you want to go to them and be like, hey, if I pay this, because again, you're lucky if somebody pays it. Somebody can be going, oh, this somebody else bought it for pennies on the dollar. It's going to be gone in 7 years. I could live with it. So if I'm going to pay you, could you delete it off my credit report as if it was never
right.
there?
Okay.
So
Thank you.
that is an option.
There's something that Tanisha just said that's really important, which is get it in writing. Sort of the two real bad players are cell phone companies and dish companies, like where you actually
Oh,
have the
Mm,
equipment. Um,
yes.
if you turn your dish in, get it in writing. They'll
okay.
Yes.
say, "Oh, we'll just." You have to get it in writing because they'll say, "Oh, well, we never got it," and the next thing you know,
They,
You're being
you're
charged.
you're being
keep
charged.
those. Yep.
Exactly. Get
Keep that
everything in
delivery
writing.
slip.
Okay.
Yes. It's always just a CYA because
Thank you.
keep those receipts. You're welcome. Okay, so we do have some people with student loans, and let's just kind of talk about them, right? If you just starting off, like if you're in default with the student loans, you have four options, right? The wonderful one that we all wish we could do to not be under this debt is pay it all back. Um, Maybe not very realistic for everyone, but you can also begin a repayment plan. You can rehabilitate the loan. It takes about 10 months to do that, or you can consolidate, and you can only kind of do that once. And there's also income-based repayments that must be renewed annually, but there are options for that. And then there's also like the Perkins loans can stay on your credit report until paid off. Perkins are the need-based loans, which are like interest-free during school. And if not dealt with, they can start to garnish you. But once you deal with it, you're eligible for student loans again. And this is called like being reinstated. And it takes like at least 6 months. And you can only do this once. And there's no room for missing a payments after that. Kind of think of it like a bankruptcy or like a chapter 13 type of bankruptcy, right? You want to stay on top of that. You want to make your payments all the time, and you just want to be in good standing with that. So with the Supreme Court, like overturning student loan forgiveness, borrowers will have to start paying those loans back. And that was in October, right, of 2023 and that time period, right? So call your server if you're having issues, if you're having like just any hardships, and I will say this till I'm blue in the face for any creditor for any time you, and I know it's so natural for us to kind of want to avoid those things, but there are so many resources available to you when you are facing financial hard times, and your creditors or the people that you have any kind of debt or credit with are really the best source of getting you back on track. And again, it's advantageous for them to get you back on track and get this paid in full for them as well. But between like October 1st of 2023 to about September 30th of 2024, during that period, borrowers were shielded from like the worst consequences of missed payments, but we're back now, right? And with that, you just want to make sure that you're current and the ways that you can get current and the ways and the options and the resources available to you.
I want to say one thing about income-based repayments. One, it's a good idea. If you don't have enough money to pay your student loans, get in an income-based repayment plan. They're
Yes.
really excellent ways to reduce the amount of money that is going out of your budget. And here's another important piece about income-based repayments. There are certain jobs that if you work those jobs for 10 years, you actually do get student loan forgiveness. You don't have to do 10 years in a row. You can kind of come and go on what the jobs are that allow you to do that. This is the important part. If you are in an income-based repayment, and let's say it's $0. Let's say you do not have to pay anything for this year because you're not making enough money to do that. That is very common. That does happen. Don't pay anything because if you pay money thinking, oh, well, I'm just going to reduce, the amount of, because I happen to have a little extra cash. If you do that, it negates your income-based repayment plan. So if your income-based repayment plan says you're going to pay $10 a month or $100 a month or whatever it is that the calculation does, pay that and only pay that. That's all.
Are there any questions? Please feel free to throw them in the chat or speak up. So, lastly, because again, we're finishing up from last week, what the call to action was for you to think about what wealth looks like to you. Just wrapping this up, we talked about wealth, and it was like a continuation of our values, strategies on paying down debt, um, your credit report, and things like that. And now we're going to get into the next one. So let me close this one out.
I have a
All right.
question that I'm hoping you
Yes,
guys will put
ma'am.
in the chat. It's a question I'm throwing out. How many of you have frozen your credit reports? And how many of you are going to be for so if you've frozen it, let me know. Good. Thumbs up. Thank you, thank you, thank you for doing that. If anyone has any questions on how to do that, please ask me.
Awesome. Okay, so getting into tonight's third class, we are going to be talking about saving for goals, emergency saving, insurance, and investment in retirement. So, how do I prioritize what to spend money on, right? So, sometimes the amount of stuff we have to spend money on can be overwhelming, particularly in today's economy. The financial plan we will tackle in our last class will kind of just help us sort some of that out. But today, we'll talk about some of the important categories which all money smart people like invest in. So, remember how we kind of talked about debt, the snowball, and the avalanche? Just very recently, with those strategies, we paid the maximum on our highest priority and then the minimum on everything else. We also use that same concept to kind of think about how to pay into our savings, investment, and insurance. The priorities and levels of payments are up to you and should be based on the values and spending personalities that we discussed in those first classes. So, just as an example, one of the spending personalities that many of us kind of identified or really, I think, talked about was And of course, we're not all just one thing, was the security personality, where that money makes you feel safe, secure, and in control of your financial plan and future. So, some of the spending categories that most of us use on a regular basis, they're not all, but just kind of some of those bigger ones. Thinking about and on this, these like we've taken out the must-haves, right? The categories like housing, food, utilities, transportation, healthcare, children or childcare, taxes, and any of those like basic living necessities are not part of these spending categories. These are kind of more the planning and things that make life fun. So, for that security type personality, where do you think, or what do you think their top three priorities would be? And you can put that in the chat. Like somebody that says, money makes me feel secure. I want to have a financial plan for the future, and really maybe kind of has some of those traits of possibly being frugal and maybe denying things that they want while planning for later. Yeah, Michelle said retirement investments. Krista said debt repayment, emergency insurance. Those sound like somebody with a security personality type. Suzanne said, I'm security, and for me, it's insurance, emergency fund, and investment. So very on par. Now let's kind of contrast that to someone who might be have a little more of the free spirit or spontaneous personality. And remember, those are people who may not have money as a priority, or people who may let money help you, or their thinking is money helps you enjoy the moment. What do you think their top priorities would be? Yeah, Michelle said ease of life. Sierra said travel and entertainment. I totally agree. And I want to be clear, like, no matter what your personality type is, these categories are things you should consider for your personality type, for your values, for your future plans on how you want to prioritize your spending. And then Krista said entertainment, traveling, ease of life. Yeah, those sound pretty on par for somebody that's spontaneous and a little bit more free spirited. And then I want you to kind of think, and please, if you feel up to it, like throw in the chat, what are three of these top priorities for you? I definitely feel like travel and ease of life are two really big ones for me, but just emergency fund and like that is really one of the biggest things for me, but I really want to enjoy life. So, entertainment, ease of life, those rank pretty high for me. All right, it looks like Michelle, emergency fund, and Ashley, oh, yep, travel, fitness, emergency fund. So, and again, there's nothing wrong with prioritizing whatever you value. Yeah, home improvements is a big one. I mean, getting to the house is really just the first step that I think people kind of underestimate and how much you need to invest in your home. But like gifts, debt repayment, and investment, those are really great things. Matthew said retirement, travel, emergency. So it sounds like travel and ammo. Yeah, stocking up on that. I fully believe that there's going to be a zombie apocalypse one day. So ammo to me is always a good thing to stock up on. Um, so then let's move into like our goals and how the spending categories and our values and our personality kind of play into those long-term goals, long and short term. Since we're kind of revisiting week one, let's also think back on what our long term and short term goals are. We had asked you to kind of think about some of those, and if you can think back to that, the hope is not to like go into debt to achieve those goals, but to have really clear goals and strategies and smart goals to be able to achieve them. It'd be great if you wouldn't mind sharing a goal in the chat or feel free to speak up. And yeah, a big goal, pay down debt. I think a lot of us kind of really feeling the pinch of like inflation and just trying to get as debt free as we possibly can. I definitely second that, Michelle. Um, And Suzanne said, my goal is to buy a building and retire. What do you want to do with the building, Suzanne? Retire in the building?
I am planning on diversifying my investments. And so it will eventually become sort of a cash flow. It'll help me
Hmm.
give money every month, assuming I can get it rented out. But yes, it's definitely as a way to diversify.
Yeah, like I said, travel is a kind of a top priority for me when it comes to spending and my financial plans. So I really want to be able, my youngest child is going to graduate, and I absolutely want to be able to like spend the winter months and somewhere warm. I'm thinking like Mexico, and I've been really saving for that as a long term. It's been a long term goal. And I prioritize it. I have a completely different separate account that I put money into just to be able to say, like, okay, and I'm really looking forward to this October to get on a plane and just go live somewhere where it's warm and I get sun. And then it looks like there's some goals in the chat, and Krista said, I just met my goal. Congratulations of paying off debt, except student loans. Oh, yeah, that's even a hard one to include. Next goal is to start my business and get building. I own renovated, and then it kind of cut out there. And then Kivante talk says, my goal is to fire my boss and become yes, I love that for you. I definitely feel that and become a full-time entrepreneur. Um, I'm so excited for all of your goals. I wish that I could check in with you 3 to 12 months from now to see where you all are. So that's awesome. Thinking about emergency savings and so many kind of things, I'm sure you've heard different numbers on how much you should save, and then also knowing that this is just like a hard time too for people to be able to like do a ton of savings. I think I saw something saying that a lot of Americans don't even have $1,000 to cover an emergency. And an emergency savings account is a crucial financial tool. It just provides like a safety net for unexpected expenses or any financial hardships, and it will just serve as a buffer to help you cover immediate and unforeseen costs without relying on like a credit card to get into more debt, loans, or disrupting your long-term financial plan. Right? Just I was talking to a friend earlier. I think like most of my problem and just to be so fortunate, right, could be solved with money and a little more time back to myself, right? If I could just things I have problems that if I could throw money at it, they would go away. And the place where you live of like when you're not financially stable and having that rainy day fund, that's stressful. And just some of the reasons why having an emergency fund is crucial, right? Job loss, car repairs, medical emergencies, home, and like even just, well, if you have Apple or an iPhone, you might need to get that repaired. Android users don't usually have those problems, but job loss, right? If you suddenly lose your job today, having an emergency fund will really help you cover those living expenses and provide that cushion during that transition. Right now, if you did not have an income, how long would you be able to survive and support yourself and anybody else that is dependent on you for their support as well? If you feel comfortable sharing, please add it to the chat. Car repairs, those unexpected repairs. Oh my God, my engine light just came on. Even the anxiety of that, right? What is like if I have to go and get my car repaired, do you have enough funds for that and not have to put it on a credit card? 1 in 4 Americans have an emergency fund, right? So it's not like this. It's just something that gets in the way of a lot of people's financial plans. And now thinking about that emergency fund, how much would you need to, what would make you feel comfortable as having an emergency fund? Please throw it in the chat. Like, what is a comfortable number of an emergency fund you think you would need to be able to have a buffer? Let's say 3 months. And with thinking about that, right, we know that there's a lot of factors that go into that, and how much do you need is specific to you. This is like one of the best kind of guess scenarios, right? You're guessing, you don't know. But experts will kind of tell you that a renter should have 3 to 6 months of an emergency savings pot, and a homeowner should have 6 to 9 months of an emergency savings pot. How much is that for you, right? Thinking about that, I think it's a great goal, but not particularly realistic for everyone. Plus, there's a bunch of other factors that go into figuring out that, right? Things like your job volatility, your family size, if you own or you rent your home, and your health, relatives' health, family members. But you also might need not need as much as like someone else might need, right? So you can move in with it like your need, or do you have an alternate way to get to work, like public transportation, a bicycle, or someone who can drive you? Because there's also resources too, that if you can lean on resources like family members that might be able to help you, things like that, that's also good. But just as like a homeowner thinking about like an emergency savings, I would feel comfortable with $15,000 would make me feel really good as like, okay, this is a great cushion. Suzanne, what do you feel like? I know you put 10,000 as a minimum, but where do you kind of land on emergency savings with your family size?
So my emergency savings is $50,000. And that's because if we were to lose our jobs, unemployment would not pay for our minimum payments every month. So we have that as a cushion. I don't think that's realistic for most people. I'm 62 years old almost. And so in reality, I've been working a lot longer than most of y'all have. Um, yeah. 50,000 is what I do, but I say 10,000. It's really important and you don't ever touch it. Put it into, an account that you can't get to. I have
Yeah.
actually had last year, so I have 10,000 that I keep just for my home repair issues. And I had two water heaters blow up in less than a month and a half. One
Mm.
on my rental and one in my house. And that $10,000 was gone just like that.
Oof. Yeah. And with that being said, even having a $500 cushion can be helpful, right? If you start by just automatically kind of putting aside $25 per paycheck in a separate account. I I've kind of been moving the cash too. Like I think that's also a good way to save money, right? Being able to have a little bit of cash handy. And even $25 a month will start to accumulate faster than you think. And then Krista said, I'd love to have 20,000 emergency funds. Yeah, for 6 months of basic income. But in the past, when we have emergencies, we get roommates or other hustles. I love that. Yeah, just to keep it going. So, financial protection, why insurance is important. Insurance just can help mitigate the financial impact of unexpected events, right? Like a car accident, health insurance for any illnesses, renters or home insurance for like natural disasters. It just provides a safety net by covering the cost associated with those events, right? Insurance is basically a way to protect your assets. Right. So, just some of these insurances, risk management. It's insurance that allows individuals and businesses to transfer the risk of potential losses to any insurance company. It helps like protect against the financial burden of large unforeseen expenses. Um, peace of mind, right? Knowing that you have emergency coverage can provide peace of mind, reducing anxiety, stress, and anything that's associated with any risk or loss that could come up. There are some legal requirements that come with certain types of insurance, such as auto insurance. It's usually legally required for you to have some level of auto insurance when you're out here driving on the road. Right. And then there's lender requirements. Lenders often require insurance coverage to protect their assets, such as the home loan, a car, or a business. MISO has an insurance class specifically for small business owners that goes into a lot more detail. So look out for that class as well if you're interested in knowing more about the MISO or about the different insurance types. All right, and we're going to touch on some of those, right? Insurance is a contract that provides financial protection against specific risks or loss. So, in exchange for regular payments known as premiums, the insurance company agrees to compensate the insured for coverage lost or damages. And just here are some of the type of insurances that we have, right? As we talked about, auto insurance required in most states helps pay for the damage of your car or the other person if you're in an accident. Health insurance, another one, is typically required by law, and if you don't have it, you'll be penalized on your taxes. There's homeowners insurance and renters insurance, but the homeowners insurance can just help you pay for damages to your homes, your belongings, if there's a fire, theft, or other events. Also, many mortgage require mortgage insurance, right? So if you are in the process of purchasing a home, I highly recommend that you meet with like a HUD counselor to really talk you through some of those things. And then renter's insurance is similar, but it's for people who rent their homes. It's cheap, usually great thing to bundle, and can usually be bundled like with your car insurance. And then life insurance. This can just help provide financial support to your family when you die. It's not an if, it's a when. So, being able to be prepared for that as much as you possibly can for who you're leaving behind. There's also just like a variety of other kinds, right? There's travel, funeral, natural disaster insurance, earthquake insurance, just so you know, which is not usually included with homeowners insurance, and the same is also true about flood insurance. So if you are a homeowner, check on those specific things to see if they're included. Um, and then liability insurance is also something to consider, especially for homeowners. Am I missing any? And I see in the chat that Michelle mentioned business insurance. Does everyone that has a business have business insurance? Um, For my business, I don't have business insurance, but the basic start of my business was mobile notary, and I've kind of branched out to some other like legal services. And with that, I have error and omission insurance, and it kind of covers anything that I would do. Like if I mess up on some kind of notary, I have that. I think I'll need it for my cleaning business. Yeah, I would imagine that it would be good just to protect you and the people's homes you're going into. Anything could happen. Michelle said you have business insurance. Michelle, would you just mind sharing like what it covers, how much it costs? And you can put it in the chat, but it'd be great if you share it with
No,
us.
that's okay. Yeah, it costs me about $40 a month, and I had
Oh,
to
that's
pay
good.
100 about 130 down. So I think that's totally reasonable.
Yeah, it
I'm
is.
totally
That's
okay with
pretty
that.
manageable.
For the insurance it gives me, I'm really happy with it.
What does it give you? What does it entail?
I haven't read it in a while, so I really can't quote on that, but I do have it, and I'm looking into getting bonded as well for the
Yeah.
cleaning business, just for extra security, you know. So those
hmm
are two things that I'm doing.
Yeah, thank you for sharing that.
Oh, sure. Thank you.
And then I see that Krista said I've priced it out and plan to get it soon, not opening until May. And then Matthew, I see your question here, and I guess I'm not seeing where it follows the thread, but it says, what will yours be?
Yeah, in reference to Krista's, I'm curious about
Oh,
insurance.
yeah.
Do you mean what company that Krista's looking at?
No, what kind of businesses are they opening, and
Ah,
like what kind of
I'm
insurances?
opening a retail shop and it's has to do with food. So it's and for like the including umbrella, like the highest insurance you can get, it was like $50 a month. So it really isn't.
Oh, nice.
And I can tell you, I have to look it up, but I can tell
Oh,
you, I'll
okay.
put it in the chat what
All
the
right.
company is that someone told me, and let me just look.
Thank you.
Yeah, thank you for sharing that. Okay, how to reduce your rates. And this is one of those things that, there's just kind of things that go into it. And you'd be surprised where you can save. I think a lot of us, and I'm very, very guilty of this, but I've gotten so much better since teaching this class, is shopping around for insurance. I am a USAA member and have been for a long time, and I've always just been like, oh, they're probably the best insurance I could get. And once I start shopping around, I was like, oh, maybe not. I mean, definitely shop around. It's very, very important to getting the best rates for you. So, does everybody know what bundle credit score does affect the rates? Yes. And we'll touch on that in 2 seconds. Does everybody know what bundle and save means when we are talking about insurance? Is anybody bundling and saving right now with different insurance products through one company? And you can feel free to throw it in the chat, because really shopping around, many people just get stuck in the one company. But when you shop around, you can significantly reduce premiums and increase coverage. When you do shop around, do your best to compare like apples to apples. So get multiple quotes, and that should just be true with any service or contract-based thing you're doing. Get multiple quotes. Consider the deductible, right? I'm seeing now, I just kind of remember growing up, and I'm 43, it would be like 500 or 1,000. Now I'm seeing, like, I think I saw one that your deductible is like can be 1,500, which I don't think is that great. I wouldn't want to have to come up with 1,500 as a deductible, but I'm starting to see things like that. Ask your agent how to save. I know some auto insurance want to be able to track how you're driving, and now that's a factor in saving. Also, there are like safety and security measures to receive incentives. I know that my kids being added and being good students was a thing that brought down that percentage. And then review those policies annually, right? And then just to kind of touch on some of the questions, you're right, Michelle, credit scores do affect that rate. So the federal law allows companies to look at the credit report. An insurance credit score is not the same as the FICO, but is similar. And it says being credit invisible though does not impact your rates. Do we remember what being credit invisible was? Did we talk about that? Okay, I can't see anybody. So basically, when you don't have any credit, like not having credit is
Mhm.
always a little bit worse than having bad credit, because you're kind of a loose can. They don't know what you will do. Can you renegotiate once your credit score goes up? Shop around. I don't, is when you say, Krista, renegotiate, is it because you just like that company so much that you would want to do that and stay with them as opposed to shopping around?
I guess I was thinking it'd be a hassle to change my insurance every year, but I'm sure,
Yeah.
um, especially like homeowners insurance. I don't
Oh,
know, but
yeah.
maybe I should.
And you don't have to change it every year. I mean, it
But I could just be
literally
like,
could just
I'm
be
just
looking at
double
quotes.
checking, and
Yeah.
maybe I mean, I just don't know if they'll lower it if I say my credit, because we just paid off all our debts, and we used to have no credit because we just didn't have, because after we filed
Hmm.
bankruptcy,
Yes.
we went through their program and it was like, don't have credit, like don't. don't use
Yeah.
them. So we didn't. But but anyway, so we built it up now, and I think that I'm hoping it will help some of those expenses. But I guess I can try it, right? Just call my current, and I'll try
Eh,
some ones too. But
yeah. And I mean, you could always just be like, hey, I got a quote from here for the same thing for $20 less. Hey, I'm moving to them, or can what you it's not like they're gonna ask you for the quote, right? I don't know. You can always try that as well. And who's to say that something is better, but if it is, you should know. Um, and then it looks like Kivante said for my auto, I usually shop around every year and have saved myself money on numerous times. Yep. Um, yeah, Chris said good idea. Michelle said I'm not bundling. And Michelle, when you say you're not bundling, do you have multiple types of insurance just with different companies?
Yeah, I do. I actually share a car, so I help with insurance, paying it that way. So I have my business insurance, renter's insurance, and that's the only insurance I've got. So I can't really
Yeah.
bundle it. I can't really bundle business
Yeah.
and renter's insurance, can I? I don't think so.
I I don't know, Suzanne, I'm gonna ask you to kind of touch on that. I know that I can't like bundle air and emission insurance with like USAA or anything like that.
Right, right. I didn't think so.
That's what I've seen as well, but I think it depends on the company as well. The other thing is the shopping around, it's not just increases in your credit score that's going to help you out. Let's say you change how far your commute is to a much less. Sometimes
Yes.
companies
Mm,
will base, how much money you're spending on that. If you've got a student that's driving the good grades, well, they didn't get good grades
Hmm.
last year, but they did this year. So
Yeah.
any of those like changes, I would renegotiate. The insurance companies are really banking on people not wanting to change their insurance. It's actually not
Yes.
that difficult to do. And it can, like Kivante said, you can save hundreds of dollars. It's crazy how much they sort of jack up the price every year because they know you're going to
Yeah.
stay.
Yeah.
Yeah.
And Credit Karma is like a good place for that too. Or I've found that to be very useful where they do have like auto insurance and they're showing you different rates based off of very kind of preliminary, but it's a good place to start if you want multiple quotes at one time. And right now it's break time and we're a little bit kind of halfway through. So do you guys want to start back at 7? And that would be a 10-minute break?
Awesome. All
Yeah,
right. We'll
okay.
take a 10-minute break. We'll see you guys at 7.
All right.
So, Tanisha, I want to make one more point about insurance.
Yes.
So, this is especially important for Michael and Michelle. Is Michael here still? Michael, you're not.
Matthew?
Matthew.
Oh, I
See, I did it again. Wickman. I have a friend
it's
named
okay.
Wickman. Sorry about that, Matthew. Okay, so the main reason I started an insurance class was because we had some experiences with people, business owners in Southern Oregon during the fires. Please read your insurance policies because, oh, there's Matthew.
Yes.
So I cannot stress how important it is to read your insurance policy to know what's in there. Your insurance agent can lie to you. There is no repercussions if they lie to you, and so you need to make sure that what they said is really what you're getting. So this is what happened to the fire victims in Southern Oregon. These were people that had equipment that they carried with them in their vehicles. We had two people that were gardeners and they had their gardening equipment in their truck, and their truck burned, and none
Mm,
of their equipment was covered because it was only covered if it happened to be at the location of the business. So there are like
it's
these little things.
devastating.
It's like, and they couldn't fight it. There was no, even though it was really
Oh.
slimy, so please, please, please read your policies. I know it's little writing and I know it really sucks, but please read it. That's all.
Oh, that's devastating to
It is.
hear.
It's horrible.
Yeah, that sucks. Um, yeah, let's now transition between insurance and investment. So, just like a little bit about just some definitions for term life insurance. It has a set limit of time for coverage, while whole life insurance, which is known as like permanent life insurance, remains in effect for your lifetimes as long as you pay your premiums. The premiums you pay for term life insurance go towards like the death benefit you will leave to your beneficiaries. So think of term life insurance as the car insurance of your life. And then Suzanne, do you want to kind of touch on some of your term life experience?
Yeah, this is just a math issue. Whole life insurance is very much pushed by the insurance
Hmm.
agencies because they make a lot of money on it. Um, if you, okay, I'm not going to tell you not to do one or the other, but if you are not good at investing your money, you might consider whole life insurance as a forced method of having you invest. The thing that's important to know about whole life is, though, you don't get the investment and the death benefit. You get one or the other. Um, and the rates of return are just not very good when it comes to whole life. My advice would be do the math, which is what I've done here on this slide, basically showing that if you were to just invest that money conservatively in the US stock market, you would make more money than you would if you go for whole life insurance. Yeah.
Yeah. So, just kind of a little bit of like a warning. So, life insurance is a very person specific kind of proposition. So, please assess your own situation before like making any decisions, especially if you already have life insurance or if you're the kind of person that uses purchasing whole life insurance as a motivator for investment. So just a little bit of calculation on that is that with whole life, it gets an average rate of return at about 1.5 between that and like 2.2%. That is not a good return, right? So also your beneficiaries, as Suzanne said, they do not get the cash value of the account, just the death benefit. So the only way to get the cash value is to close out the account. So with like a 7% annual rate of return, you would have more money in a 30-year period than if you invested it. So the rate of return for the past decade ranges from about 10% to about 14.5%. So if I use the most conservative rate of 10%, the same example would earn you about 919,000. right? So this is also what we have on the screen is just a little bit of like the math of that, right? So the average cost of life insurance for a non-smoking woman at 35 is around, let's say, about $40 a month. For about 500,000, 30-year term policy, that same person would pay about $481 per month for a whole life policy. And as you can see that difference, right? It's about $441 a month. But if you were to invest this in compound interest account, again, with that 7% of annual return, you would have about $519,820. So really make sure, again, that things are aligning with your values, knowing your spending habits and personality, and working what's right for you specifically. There is no one size fits all when it comes to your financial plan. We're just giving you tools on how to optimize your financial plan and your goals.
And I want to give a plug for AI in this particular case because if you do the math, it's really complicated, like to figure out how much money, but AI will do all of that for you. So
Yes, throw that into ChatGPT.
I love to
Learn
chat.
those prompts. Ask it to pretend to be like an expert insurance broker and have them figure it out. Um, so, what are some basic low-level investments everyone should have, right? We spoke about the emergency fund, insurance to CYA for those unexpected um emergencies, right? And then there's your 401k or a 403b, which would be more of a nonprofit. There's that 457, like, which is which is a B, I'm sorry, and that's like state and local government. TSP for Fed, Simple for small businesses, which are like under 100 people. And then there's also the SEP, which is the Simple Employee Pension for people who are self-employed. Does anybody have a 401k or some type of retirement savings plan or tool that they're utilizing? Go ahead and throw it in the chat if you are. Um, or please feel free to speak up with your experience about it, right? So, thinking about how, okay, we got some stuff in the chat. Sorry. I love AI. I don't. Okay. So think about retirement, right? So retirement was originally conceived of as a like a three-pronged stool where you have your Social Security, personal savings, and or a pension. And for most people, the pension is no longer an option, right? And has been replaced with these employee-sponsored IRA plans. But this just means that you still probably need to have other savings in order to live at your current lifestyle, right? When you stop working. So the other investments and all those things kind of go into a funnel, which we cover now, right? So thinking about your retirement savings, these investments will also help you build generational wealth, which is also called intergenerational wealth transfer, which is a goal that I'm assuming we all kind of want to have, right? And as we've talked about in the class, the racial wealth gap also impacts intergenerational wealth transfer. Just like in the Black community, one thing that I have particularly noticed, which is not true for everyone, is that we're always kind of going back and helping family members and older loved ones and not being able to always pay that forward and leave inheritances, homes, and things of that nature. Um, so think about that as well, right? If you are a white family, the average amount of money you would bequeath is almost around $200,000 compared to a Hispanic family, which would probably leave, or which typically will leave around about 130,000, and Black families leave just a little bit over 75,000. And by the way, like these picks are all members of our MESO community. But just thinking about your retirement in the long run and how you want to live in the long run, thinking about that end of life care, if you're not able to stay in your home, if what does that look like for you? And whatever you don't plan and work out, somebody else is going to do it for you. And the options may be limited and it might not look like what you had in mind or what you want for the later years of your life. And it looks like in the chat, um, Kivante said you have a 401k and a Roth RA. Okay, we love to see that. Go ahead. And then Krista said we only have real estate investments, but it will cover us. Great. You know exactly where you are and what you need. And then it looks like you guys were having kind of a conversation about is this a second home or your primary or maybe some other type. And then great, Krista. You have a primary home, some land, and a cool old elementary school. You guys have an elementary school? Will you tell us more about that, Krista?
It's pretty cool. It's actually
Yeah.
14,000 square feet, and it's on 2 acres in this middle of nowhere town. Um, and we're working on slowly. We ran a bed and breakfast in Portland for a long time, and so we
Yeah.
were kind of like, oh, the plan was to move there and turn it into a bed and breakfast. But of course, it's going slowly. But
Yeah.
that's kind of it's pretty, it's cool. But
Yeah.
um living between Oregon and New Mexico is harder than, you know.
Yes. It can be, yeah. But, that's a really cool thing. There's a lot of things that you can do with that. And yeah, a school does sound pretty cool.
And it was really
And
cheap.
yeah, I'm not mad at that. I've seen people turn those schools into like micro apartments and things like that. So it'd be great to see what you guys end up doing with it. Suzanne threw in the chat about 40% of Americans between 45 and 64 have no retirement savings. So thinking about again what you want for that end of life and what that looks like. Because you have your best interests at heart compared to, maybe other people. So compound interest, throw a one in the chat if you kind of know what that concept is, and we'll talk about it more in depth here. But compound interest is just a concept in finance and investing that refers to interest earned not only on your initial amount, which is, the principal, but also on the accumulated interest from the previous period. So, in other words, it's an interest on top of interest. So, yeah, I know that with the rule of 72, it's an easy way to like calculate approximately how long it will take you to double your money. So you just take 72 divided by the interest you are earning, and that will tell you how many years it'll take you to double your money. So looking at this example that we have of compound interest, you can see here if you're 35 and you invest 2000 at 7% by 65, that's 15K, right? If you're 25 years old doing the same thing, you'll have 30K. But thinking about that rule of 72, thinking about if you invest 500 at 10%, that interest will double in about 7.2 years. Does that make sense to everyone? Is there any further questions on the rule of 72 or how compound interest works? And feel free to throw them in the chat as well. All right, investing and retirement. We're going to just look at investing as a way to save for retirement and generational wealth. But also know that many investments can go towards living expenses, paying for other investment options, or even paying down debt, right? As small business owners, you can purchase these retirement options for you and your employees. And it's called a simple IRA where employees can contribute and an SEP, which was that, right? SEP retirement where only the employer or the employer can contribute. So, like an FYI, thinking about a 401k is for like a corporation, a 403b is for nonprofit, and a 457 are mostly those are government ones. So, in most cases, these retirement options have match contributions, usually between 3 to 5%. And in other words, if you put in 3% of your salary, your employer will match it with 3%. And you know how we mentioned and put an emphasis like on a few things throughout the class? Well, here is like one of those number one pieces of advice. If you are not already contributing to your employees' match retirement, do that. Do it tomorrow, right? Thinking about oh, sorry, did it skip the
I think it just moved one forward.
No, it moved like two forward. That's weird. Sorry about that, guys. So if you're not doing that, like get on that because the thing is, it can be confusing, but you can choose like normal IRA or Roth IRA option. Which fund like do you choose? Well, like let's look at some of those basics in the next one, but thinking about that employee match, right? If they're matching and you can go to the max with that contribution, right? Like get as much as you can out of it. And now thinking about the Roth IRA, yes, I know, Krista, that stuff can be really confusing. Do you have any like specific questions? Because we can answer some of those things for you right now.
Honestly, I'm gonna listen to the whole listen to
Okay.
what you have to say. It's a little bit
Okay.
over my head, but yeah, I probably need to take a class. But anyway, maybe I'll have some questions at the end.
Okay, sounds good. Thank you. So thinking about IRAs, right? So there's the Roth and there's the traditional one. Employee sponsored Roth IRAs are paid from your paycheck after you pay taxes. So you have access to the funds after the age of 59 and a half, where you will not be charged taxes on any of the gains. The Roth IRA can be used before 59 and a half with no penalties, but you will have to pay taxes on the gains. So there is like a carve out if you're a qualified first time home buyer who hasn't owned a home in the last 3-year period to closing, you can withdraw up to 10,000 to buy or build your first home without the 10% tax penalty. So some of those qualifications, like only people making less than 144K are couples. Sorry, one second, let Matthew in. Or couples making less than 214K are eligible, and the maximum contribution is 22 and a half, yes, 22 and a half thousand unless you're over 50, which at that point you can put in 30K. There are no minimum distributions, unlike the traditional IRA. So, thinking about a traditional IRA, those are taken out of your paycheck pre taxes, which means your tax bill will be lower. The maximum you can put into a traditional IRA is 7K and 8K if you're over 50. So when you take that money out after the age of 59 and a half, you will have to pay income taxes on it. If you withdraw the money before 59 and a half, you will have to pay a penalty unless it is less than 10,000 and you're using it for first-time homeownership or higher education. But once you turn 72, you will need to take out a certain amount of your IRA that will change over time based on how much you have in your IRA. Yes, ask ChatGPT to break it down and put it in a PDF and read it. That's what I do. I totally agree with you. I feel like ChatGPT is a wonderful tool depending on how you use it to the information that you want to get. Like anything you don't understand, throw it in there. I mean, it's consider the source, do extra resource, but it's a really great starting point to get things figured out. Um, and I also suggest like you don't have to spend a lot of money, but learn how to make your ChatGPT work for you. Find out the right prompts to get the most accurate information that you can from it. Of course, it's still AI. Don't 100% rely on it, but also use it as a tool when it can be useful to you. But going back to IRAs, so thinking about if you believe your tax bracket will be lower when you retire than it is now, a traditional IRA would be good for you. And just a hint, like when you start taking money out, take out your traditional IRA first, as this will allow your investments to earn money for you tax free, and you won't come across the potential that your tax bill will be high with your minimum required withdrawals. And just as a bottom line, right? Both are great options to help you reduce your taxes. Traditionally, you reduce your taxes now, or I'm sorry, in the traditional IRA, but then with the Roth, you reduce your taxes later. So don't worry about choosing wrong. And just like as an FYI, there can be a mix of a Roth and a traditional IRA. So there are options. Again, goes back to your values, what you will need, and what that looks like for you. Also, if you would like, MESO has a class on AI on March 3rd. So check that out if you want more information on how to use AI, which I know people have mixed feelings about. It can be something you've never really dabbled in, it could be something that you love, but the class could just be useful information. All right, so investment options, bonds, and index funds. I know that even that can be very confusing. So you've all probably heard of these, but might not know exactly the difference or which one might be right for you. So a stock gives you partial ownership of a company, which may come with voting rights and or dividends. There is no guarantees of returns, right? A bond is an IOU from the government. Bonds pay a fixed guaranteed interest rate of around 5.36%, which is low compared to the stock market, but it has low to no risk, right? So to put that into perspective, on at like the on point premium bundle interest rate is currently 5.25%. So, thinking about that, an index fund is a collection of stocks that aims to mirror the performance of an existing stock market index. So they don't try to beat the market, they just want to mimic the market. And since the market in the US goes up over time, so index funds perform better than managed funds like mutual funds, and typically kind of carry less risk than stocks. So in index funds, they do gain and lose value, but over time they have historically gone up. So even during COVID, the index went up, but there are over 500 different funds. So how do you know which to choose? You can always use Google, you can always do Chat GPT. Um, but what index funds, like search what index funds are performing the best. Some of the ones you may have heard of are pretty common, the S&P 500, NASDAQ, or the Dow Jones Industrial kind of average. One really good option is finding target date funds. So for these investments, you literally select the year you're going to be able to access the funds, like a retirement year or a year you'll start school, and the fund manages the risk. So as you get closer to the date, you're going to use the money. The investment will get less and less risky by increasing the number of bonds in that portfolio. Um, and just when you're choosing funds to be used, pick the option that has the best performance and look to see which funds charge the lowest fees. And just think of it like the bottom line of this: open an IRA, select an index fund, and relax. Just like set it and forget it as best you can, and go about it that way. Is just kind of like a safety rule of thumb. So, how much and how? Like, how much do you need to invest? Is anybody investing right now? Does anybody have experience with stocks and index funds? And how are you managing that? Please feel free to throw it in the chat. And thinking about how much do you need to invest? There's no answer to that. Again, it comes back to your values. 50% of women between the age of 55 and 66 have zero retirement savings. So even putting a small amount will put you ahead of the curve. Your goal will be to eventually put 15% of your income into retirement savings. To make this easier, we always recommend automating investment. Even using apps can be a really good option. If you take the money out before you get it into the bank account, it's out of sight, out of mind. Just having it automatically go there. You won't miss that money and you don't even, know that you have it. And then Suzanne, did you want to kind of touch on any more or like get a little bit more into the weeds of that?
I think you've actually done a really good job. There is a little bit of confusion with the IRA piece of this. So the Roth and the traditional, we've got these two different kinds, but you also have employer-sponsored IRAs. And like Kivanti has, he has actually a separate Roth IRA that he's investing in. So you don't have to only use your employer, but definitely max out what you have available through your employer. Um, and then if seriously, if you're like totally freaked out about it, ChatGPT is a really good one. You can drop me a message. I can tell you how to do it. It is not as hard as it looks. It looks terrifying. But if you know that concept of index fund, you know that concept of ending date fund, yeah, you're pretty good. Mutual funds used to be like the thing that people did. Mutual funds do not be, even though they are managed, they have historically not done as well as index funds. The other thing to think about is when you do take it out, you're going to, if you have a traditional IRA, so you've reduced how much money you're going to be taxed on the year that you take that traditional IRA out. But because you are taxed at the end, it is possible if you are a very good investor that your income will be higher in retirement than it is now. For most people, especially young people, if you guys know anyone that's just got out of college or just out of high school and they're starting their jobs, please get them to start retirement savings right away. My son asked me, he said, "Hey, Mom, how much should I be putting in?" And I said, "Well, I think you should put in as much as you can afford to put in." And I said, "Can you afford 20%?" And he said, "Yes." I said, "Then put 20% of your pay stub into um, Roth IRA first. And then if you max out your Roth IRA, go ahead and put it in your traditional IRA." And when he got his first statement, it basically showed that he was going to be making, by the time he retired, he'd have $4 million.
That's
Start him
awesome.
young. Start him young.
Yeah.
Yeah,
Can I ask
Kristen.
And
a
then
question?
there was oh, go ahead.
Oh, sorry, did I,
No, go for it.
if, like, at what age does it not make sense anymore to invest?
It
And
always makes sense.
Yes.
even like, if you're already 60, it wouldn't make sense, right?
I'm investing right now and I am 62 or six,
In a
well,
Roth IRA?
absolutely. I'm putting money
Okay,
into
okay,
my Roth.
okay.
Um,
Okay, and then what about, um, if you're self-employed? I've always been self-employed, so I've never had the, like, it's just never been, and we've done well with real estate. So, but that's like tied up and, so I, I think, I should try to invest in it. Like, where do you go? I mean, you just go to, I mean,
there are companies
I
that
heard someone said
simply,
get a self-directed IRA.
yeah, a SEP or a simple fund.
Uh-huh.
Yeah, that is correct. And there are agents that sell these funds to small business owners, and you can do it so that just yourself, like you can invest in your own self, or if you have employees, you can open up SEP IRAs for them as well.
And so
Um,
I would, if I have, I don't have employees, but if, when I do,
mhm.
it would sort of be like, mm, inspiring them to work on their retirement. So that's like kind of why I would do
Yes,
it.
and there are tax
Because that,
advantages for the business owner to do that.
oh, really?
hmm
Okay.
If you
Um,
now, and that's one thing to be to be wary of. It's a little confusing, but most of the employer matched funds, we're saying Roth IRA, they often will not give you that option to do it in a Roth. They'll just give you the option to do it in a traditional because that's how they're getting a tax advantage out of it. But what I'm doing right now is I'm maxing out my match and I have to do that in a traditional IRA. And then above that, I'm putting another 10% in specifically for a Roth IRA.
And
And
then in
yes,
the chat, Michelle.
I'm
Oh,
not sure I understand the difference, but if I'm self-employed, forget the employees, I'm self-employed, I can open an account and my husband can put in 8,000 and I can put in 8,000 if we're over
correct.
what? 50, what's
50.
the age? If you're
It's like
over certain
55, maybe. I
age, you
don't
can put
remember.
more in.
Yeah.
55, okay.
55. Oh,
Okay, so, but it's 7 or 8,000 every year.
Yes, that's correct.
Okay. And then that does that help my taxes at all? Like if I put it in
So
pre-tax, then I'll pay tax later, but I want to pay it now. So it kind of defers it, but hopefully it'll
yeah,
still make money and it'll be
it'll be worth it. That 7 or 8,000, that is a traditional IRA. You can actually put more money into a Roth IRA. I think it's like
and can I
20.
have both or just
You
one
can
or the
have
other?
both. Absolutely. You can have both.
Okay.
And I
So
I recommend having, okay, if you're not making very much money, so you're not going to be paying much in taxes, then
uh-huh.
definitely go for the Roth IRA
Okay.
because you're not, it wouldn't do you any good if you reduce your income that you're going to be taxed on by $10,000, say.
If I'm not paying
Um,
taxes anyway, right?
if you're not paying taxes anyway, then go for a Roth IRA and do it like Kivante did. If you do not have a SEP fund that you have created for your small business, you can go to any of these accounts that I've got listed on this slide. You can go to any of those and you can open up your own Roth IRA. And it's not difficult to do. Literally, you
Okay.
can do it online. The whole process you can do in less than 30 minutes.
Okay. And my husband recently had a job for a stint and they did a Roth IRA for him. So
So
that
he so
so
he's
we
going to have
we
like
we
a
actually do
little
have
chunk.
one now.
So he'll have a little chunk of an IRA. This is the interesting thing with that. So he already has the account.
Uh-huh.
That is going to be an employer IRA. That's
He can,
different than your personal IRA.
okay.
Sometimes the company will let you just continue to put money into that account after you're no longer working with that company. But even if you're not, you can just open up another account. It doesn't hurt to have multiple accounts.
Okay. Um, oh, I had another
And it's
question.
never too late.
Okay. Um, I might come back to me, but I
Okay.
forgot. I had
okay.
another question, but okay.
Okay.
And before we move on, Suzanne, Michelle had a question about what are mutual funds?
So a mutual fund is you know those Wall Street folks that everybody hears about, those very wealthy people that make really important decisions?
Yes.
They're making decisions on where to invest your money.
Mm,
They're making decisions on where everyone in their portfolio should be investing their money. It is a
mhm,
managed fund. There are high fees associated with a mutual fund. When I first started my retirement savings, I did it with a mutual fund because we didn't have index funds back in those days. The
mhm.
idea was you wanted to beat the stock market. But the
Right,
reality is you don't need to beat the stock market. If you match the stock market, you're going to be
right.
doing just fine.
Okay.
So that's why I say mutual funds, they're still out there. But for me, it makes a lot more sense to go with an index fund.
IRA, index fund. Okay. Thank you, Suzanne.
Yeah.
Thanks.
Perfect. Um, so a little bit much, I'm sorry, a little bit
Oh,
more.
Krista, that is the funniest question. Is there a way to find an old retirement account that you're invested in and you lost track? Yes, and it's not easy to do. You would think that you could just plug it in, your social security number into some database and that you would be able to find this money. It's not easy to do. Mostly what I ended up doing was going through my old records to figure out, oh, that was with Fidelity. Oh, yeah, right. Yeah, I recommend, even though the whole idea is set it and forget it, don't forget the company that you're with. But then once you do figure it out, it's okay. The other thing is when I had some difficulty finding one of my funds, I was like, I remember that I had it. It was only a job I had for like a year. And I just called around. Literally, it's like, I think it was this, but I'm not sure. Oh, it's Mutual of America and not Mutual of Omaha. Okay. Yeah.
So like if you just Google retirement funds and there'll be like a list, just start calling them. Be like, do you have my
Yeah.
name? Okay.
Yes, exactly. And they're when you do that, they're going to make sure that you are you. So it's not as easy as just, them looking it up. They're gonna verify who you are.
Right, right. It's for my husband. He worked in tech for like 5 years when he was younger, but he didn't even really know we grew up poor. He didn't even know what it was.
Right.
But I'm like, there's probably some money in there. Um, okay. I think it was a 401k.
401k
Is
is the
that
most
different?
common. Yeah, even though like I'm in a
Okay, so that's a
nonprofit
state.
and we have a 401k. So 403b, they're all the
Okay.
same thing. They're all the same thing.
Okay. Okay.
Okay. So how to pick a company, right? You can ask about fees, try to find out one or try to find one with an expense ratio of less than 0.5%. Customer service, does it have the funds you want, like a target date fund? And once you choose a company, there will be paperwork which can almost always be done online. You want a copy, they will need a copy of your ID, your social or ITIN, your bank's routing number, your employer's name and address, and the name and address, and the social of whatever, like whoever you choose to have as beneficiaries. And then the final step is to set up a schedule and watch your savings grow. Set it, forget it, and go from there. And as far as which companies to choose, just try to base decisions on what organizations offer, what investment firms get the best rates. You can use Investopedia as a review source and also intentionally, if this is a value for you, intentionally finding minority or women-owned investment brokerage firms. And then there are some links that I think, let me see if I can get these in the chat. Um, and I'll go ahead and throw some of these in the chat.
I can say one that I think you're going to probably put in. It's called Elevest, and it is investment that's basically geared towards women. So they make it more understandable for our brains. And it's super simple. Like the whole setup process, I think took me 15 minutes. And then they just take money out every month and invest it for you.
Yeah. Um, Perfect. Thank you for that.
Mhm.
So when picking a financial advisor, here's some questions to ask them, right? And think about this. Fiduciaries must act in the best interest of the client, right? So they're supposed to act in your best interest. Ask about any commissions, any fees, or any other forms of compensation they receive, to ensure that their compensation and aligns with your interest, right? And there are no potential conflicts of interest in that relationship. What is your experience and qualifications is a great question. Inquire about the advisor's professional background, certificates, credentials, and ask their experience working with clients similar to you and how they stay updated on industry knowledge, whatever that, what does their professional development look like? Then asking what services they offer. Some may specialize in certain areas such as retirement planning, state planning, or tax strategies. All right. And then let's think about diversification, right? Just like with your credit, you want to have a diverse mix of credit type. Diversifying your investment is an essential strategy to mitigate risks and maximize potential investment returns. Home ownership is one of the most reliable ones where, it promotes wealth building by acting as a forced saving mechanism through your home value appreciation, right? You're building equity every time you pay your mortgage. It's the number one way most Americans build wealth. Wealth building hinges on home ownership and the ability to build home equity. A home provides safety, a tappable source of income, and a value that can be passed on to future generations, right? Real estate that is just owning properties that can be rented is a tried and true way to wealth creation, right? It does take management and knowledge, but there are also crowd-funded real estate investments too, like firms like Fundrise or Yield Street. High yield saving accounts or CDs, which are certificates of deposits, are ways to get slightly better than normal saving interest rates. So, does everybody know what a CD is and maybe the difference between like a regular savings account and a high yield savings account? Go ahead and throw a one in the chat, or if you have any questions, please feel free to ask them.
Not all banks are going to have high yield savings accounts. But like Tanisha mentioned, right now the on point high yield savings is like comparable with bonds. So it's really a great way to keep your money. You have to have things like direct deposit or a credit card, a checking account and a savings account. And once you've got that, you're eligible for the high yield savings. CD is a certificate of deposit. And basically, what that is you give a lump sum to the bank, say $1,500, and they're not going to let you touch that for a certain amount of time. And depending on how long you leave it in there, the interest rate will be higher. So there might be a 6-month CD. There might be a 1-year CD. There might be a 5-year CD. The thing to know about CDs is even though you're signed yourself into a, a timed period where your money is going to be used by the bank, if you have an emergency, or even if you don't have an emergency, if you
Hmm.
want to pull that
You can
money
just cash
out,
it out.
you can. You're not gonna have penalties, but they're not gonna give you as much money. You're not gonna get the type of interest. So don't worry about it. If you've got, an emergency fund, put it in a CD.
Yes, that's a great way. And then think about commodities, and those are things like precious metals, gas, farming products, or livestock. Those two are really great things to kind of diversify. And then one other thing, I like to mention is, there are different ways to find passive incomes, things like peer-to-peer lending, if you have the ability, renting a room, annuities, which are usually an insurance-based investment, often used in retirement. There's also like Amazon storefront, if you are an Amazon, don't want to call it influencer. I'm sorry. I'm blanking on the word right now. But you could have like your own
Affiliate?
storefront. They
Is
do,
it
it's
affiliate?
two different things. There's the affiliate program and then I don't know why I'm blanking because
Oh,
I have a storefront and I don't know why I'm blanking on it. It will come to me though, but I'll throw this and you have to apply, but I'll throw the link here in the chat. Um, Dang, it's not an influencer. I'm just blanking on the name, but I will come back to it. All right, let's get into
Let
social
me
security.
answer the
Oh,
question that Krista has in there,
oh,
asking for
okay.
suggestions about learning about real estate investing and management. So the reason I'm in the process of doing this, I've just opened up my LLC and we're looking at buildings right now as real estate investments, is because literally I had a class on it and I was so impressed with the instructor that I then went to him and he is the person that's walking me through this and he hand holds you through the whole thing. It's funny, I haven't actually scheduled him again to do this class. But now that you're mentioning it, I think, maybe I'll just give Ashley a call specifically about that. Um, so Brown and Carter is the name of the agency that we use. Brown and Carter is very active in the community. They've helped me so a lot. They've especially helped young entrepreneurs. So I just highly recommend it. I mean, my husband and I don't know squat. Well, now we know a lot about real estate investment, but we didn't know anything when we started. The other class that's taught by Ashley's wife, who they're in partnership together, um, is how to use your home as a way to leverage wealth building. For instance, if you have a HELOC, a home equity line of credit on your home, you can have access to, say you have $200,000 in equity. You can then use that $200,000 as a down payment for an
Mhm.
investment. Krista, are you the person that's going to have a storefront? Is that right?
Yeah.
So there's actually, if you own the building you have your storefront in, there are certain advantages with interest rates. So that's the kind of thing that they'll walk you through. And I guess now that we've talked about this, I will call them tomorrow and ask them to set up classes. So they're coming.
Yay. Okay, so Social Security, what you need to know about Social Security, first of all, it's very easy to check your Social Security if you haven't already. You can go to ssa.gov, set up an account, and it literally will show you every year that you've worked, the money that you made here. I'm going to go ahead and throw that in the chat. Um, Go and set that account, and then you can check your current eligibility. You become eligible after 10 years of making at least $1,360 per quarter. So in 2023, the maximum monthly amount was $3,822. The average amount, though, is 1,781 a month, but it depends on what age you start taking money. The earliest you can start taking money out is at 62, but if you wait until 70, you will make a lot more per month. So just look at the chart here that we have on the screen and say, and actually, this is yours, right, Suzanne? Uh-oh, did I lose
Sure
you?
is.
Yeah, so if Suzanne starts taking benefits out at 62, she would get $1,403 a month. But if she waits until 67, she'd get 2,282 a month. And then looking down and, if she waits till 70, she'd get that 3,036 a month. Lastly, there is a lot of talk about Social Security not being around for much longer. Social Security is a pay as you go system, and in the US, we're getting older and having fewer children. So we are taking more out than we're putting in. We have until about 2035, which seems like maybe a ways away, but is fastly approaching to fix the problem. But even if we don't, there's three things that could happen, right? We could have our benefits reduced by 20 to 25%. We could increase the amount of money going in, or we could raise the retirement age like we did in 1983 when we raised it from 65 to 67, or anyone born after 1960. Okay, so again, I think this is yours, right, Suzanne? And this is
I
kind of
think
what
this is
you'll look
yours.
at.
That's
Oh,
not
is it
mine.
mine?
I think so.
Oh, probably. And I want to preface this while I own a business, I'm also a 100% disabled veteran. So I have not been what's it called? Contributing to this for quite a while. Yeah, so gosh, I would not be able to live on even what I if I retired at 70. Does anybody have an idea of what this looks like for them?
Has anybody opened an account on ssa.gov? You checked recently? Yeah.
Good, Krista. Yeah.
SSA.gov is so freaking cool. If you haven't done it, please just go and sign in, sign up, get yourself an ID and a password, and it is fascinating. They have like how much money you made in all these different
Yes.
years. It's actually a little terrifying for me because I've spent a lot of time working for nonprofits, so I do not make a lot of money. But I know exactly, like there was one year I literally did not make a dollar. I believe I was a new mother at
Yeah.
that particular time. Yeah.
And
But
that's also, part of the reason women can be at a disadvantage with that when we talked about like how I think it was like 55 to 60% of women aren't having retirement savings. Like, really make sure that you are thinking about your future and what that looks like for you, especially if you've had gaps in your work history. Like, I was a stay-at-home mom for many years. yeah, it affects women tremendously when we start looking at some of those things that contribute to why they might not have retirement savings.
On this slide, we say find a financial advisor. That's not as easy as you would think it is. And if you just go out looking for a financial advisor, they will charge you a whole lot of money. This is the thing I have found is that if you go to the investment firm that you've chosen for your Roth IRA or your traditional IRA, you can talk to them and they're very forthright. My husband and I actually went to ours and we gave them all of our information and they told us exactly what we needed to do to retire, at what levels, are we going to be at 80% of our selling? Do we still want 100%? What's that going to look like? The other one that was kind of crazy is through my insurance, I did a bundled insurance. One of the perks that they had was to take all of our information, find what our financial situation was, what our goals were, and gave us a full binder of information on what we need to do to meet our goals. It was phenomenal. So just ask around.
Yes, and so for next week, we're going to put it all together and we're going to learn how to create our financial plan. If you already have one, great, bring it. We can help with tweaking it. There can be questions you ask. So for next week, our final class, just come prepared to talk about your income and your expenses, or at the very least, be working on it with us and we can really help iron out any kinks. If you don't know how much you make or how much you pay, please try to come with that. Like, try to have a good idea of where your income and your expenses are so we can build a financial plan. And I'm going to stop sharing and open it up for any questions that we have right now. Please feel free to ask.
Krista, I like that you actually checked SSA.gov. Yeah, it's actually kind of interesting. The other piece is if you do become a more confident investor, you can't. So if you wait till you're 70, you are basically guaranteed an 8% return. We know, though, that the stock market usually makes more than that. So if you're good with the money and you take the money out and invest it, you will actually be making more money in the long run. Now, if you live to be really old, like if you're 100 years old, it's going to be hard to keep up with that. But
When you say take it out, you mean take it out of where?
so with Social Security,
Hmm.
you
Oh, take it
tell
out
them,
early.
yeah, take it out early or
Oh.
take it out late. If you take it out early, you're going to be getting less than the amount that you're slotted to get. But if you wait until you're 70 before you take your money out, you will get a guaranteed 8% rate of return until you retire. The thing is that you're giving up that money every single month, right? Because it's like, oh, well, I could be getting, $2,500 every single month right now when I'm 65 years old. And then if you think about that 2,500, times 10, what is that? 20, 30, 30,000, something like that.
Mhm.
That's money you can invest. So it's sort of an interesting
Got it.
like game that you can play. But I don't recommend that if you're not comfortable with investing, then I
Well,
say wait, wait,
I just
wait
have
as you
been really, what do you say? Our realtor calls us the accidental investors. Like that's been my main source of income in my life is buying and selling. But like always we were like, no, this is the dream house. And then, but it's been as we've just moved every 2 years, not totally, but like every 5 years or something. And so, but like, and our plan is that we have kids and we're going to gift them each. Well, we're selling them a property each, and then they are required to take care of us to a certain degree. Like there's like a casita or like a, something for, and we're keeping one.
Yep.
So I'm trying to figure out, is it possible, like, or is it better to like will it to them?
So
Yeah, you
I
should
have
get with a
that's
probate
actually one of the
lawyer.
harder questions to answer.
Yeah.
But
Yeah.
just to let you know, so I have a home and a rental home. And
Hmm.
how we have set it up in our will is we are allowing the children to decide if the home gets sold or if one of them buys the other one out. Right now, the plan is that my son will move into our home. I will move into our basement, which is fully, it was
Right,
where my
exactly.
parents grew old.
Hmm.
And yeah, so, but we have that in our will. I also recommend getting a
A
will.
will. That's
And not
something
just a will. Think about,
I don't have one.
I'm
Need,
very passionate about this too. We don't talk about death a lot, right? And then it hits us. And some of us experience it with our parents or family member. Um, I'm not saying you need to get a trust, but do you have an advance directive? Take by planning for it now, you alleviate, it's not for you, it is for your family members. And that can go any way, right? When money gets involved, things change. Even if you have the best of a family, do you want your kids, or if that's even your situation, who do you want to make medical decisions for you? What does that look like? Spelling it out. And if you are in a place, get a probate lawyer. Just figure out what that looks like for you, because and I know that Kivante is on there, and I'm so passionate about women having a level of security for later in life. I'm 43. I spent time being a single mother. We know how those things, or not even just a single mother, I'm sorry, a stay-at-home mom, out of the workforce, and it just hurts us a lot, right? It doesn't always set us up for later. Take care of you and think about that long term impact of how do you want to live your life? Do you want to stay in your home for as long as you can? Right now, we have such a huge shortage in medical providers. And what does it cost if later you need to be in a home, right? If you need, what does that look like? What kind of home do you want to be in? How do you plan and save for that? Um, and yeah, kids are great if they're going to be there to take care. But what if that doesn't happen, right? What if it doesn't happen in the way you want it? Protect yourselves.
there was one insurance we didn't actually talk about, which is this concept of burial insurance. So it's basically like a death insurance that'll pay for your burial. I actually don't recommend that you do that. It tends to be pretty predatory. Especially it's predatory for some reason towards Black women. Like for some reason they are targeted more than any other demographic. But here's an interesting one, and it's what I have done and my husband has done, and we did it because my parents did it. I've actually already paid my funeral expenses. So
Hmm.
literally when I die, my kids have a card in their wallet. They just call and we went with the Neptune Society. It was relatively inexpensive and now it's ease of mind. They don't have to worry about it. And we even went so far as to get the international one. So like when we're going to be traveling in Costa Rica or wherever we're going to be hanging out, they'll take care of it. Like
Yeah.
and it was so easy with my parents. It was just remarkable. So if you are looking to do something for your children, that would be one thing I would recommend. The other thing that I would recommend when it comes to sort of that will piece is getting your children on your bank account with you. Because when
Yes.
you die, there are going to be bills that have to be paid every month,
Yes.
and they're going to need to have access to that money. So get them onto your checking account or your savings account.
I would definitely see that that is one of the number one things I get called out for notaries. Mom's in hospice, dad's in hospice. We need to get all of these put in our names. And then it becomes a problem, like if they're sick or something, and I have to, do you understand what you're signing? We have to go through all of these extra layers, and if you don't have it prepared. Um, so yes, and just want to be mindful of everyone's time. It's 7:58. If there's any more questions you have, you can email Suzanne. We can talk about them next class, save them. But yes, so wonderful. Thank you for participating. I know it's late and all of those things, but we really appreciate it.
Definitely. And don't forget, there's a little survey that pops up, and
Yes.
we really appreciate it when you answer those surveys. We will see you next week. Thank you,
Yes.
guys.
Bye.